Hello, Warriors. I'd like to welcome our viewers from investing.com. Let's have a great day. Have a great show. We have our usual outstanding analysts of Blake and Steve and Stelios. And additionally, Greg Horvat's going to be with us. Have an interesting guest with the dollar rallying and gold under pressure. I have a guest who runs a gold fund. So it's going to be interesting to see what Brent Johnson is thinking about the fact that gold did not respond to this. So last week when we were with you on investing.com, it was last Thursday was here. We talked about the vulnerability of the market. Not many people were expecting this type of decline. It did not surprise us. So, okay, what have you done for me lately? I think a lot of people have already discounted or Monday and Tuesday night. Monday night's already a distant memory. Everyone thinks everything's okay again. I would be looking for another short entry between 750 and 770 if we get that late this week, early next week, because even if the market's okay, we should get at least a retest of the low. And if this was the beginning of something more serious, we could have something like this from 760, maybe even a fib extension of this move, which was 10%. As far as the dollar is concerned, I want to tip my hat to the Forex analysis team, especially Blake Intraday, gave several technical reasons up here yesterday. He was short the euro, called it out live, big trade to the downside of at least 130, 140 pips down here. Looks like we are beginning to diverge here. When it comes to the dollar, although we have recovered from areas that we talked about a long time ago at 88.5, that was our target when we were up here. We still have to penetrate the 91 area to really say that there's an all clear. This, as Blake was saying, the way the market was positioned, a lot of dollar bears, a lot of euro bulls, and maybe the liquidation move yesterday has alleviated some of that position, but we still need to close back over this low of 91 to give an all clear on the dollar. Just a quick review. A lot of people, analysts included, said that Bitcoin was the market tell for stock indexes. And on Monday, I rarely cover crypto because I really don't understand the mechanics of it, but I can read a chart. And it was in here, said that I think that crypto's due at least for a bear market rally. You know, this was a nice break, almost $13,000. Why can't we rally back $6,000 back to 12, 13? And talked about the one with the best structure was Ethereum. Well, ABC, so had a nice reversal, have a nice reversal week to the upside. In this, something else that we've been talking about for a long time has been a negative stance on the crude oil market, which is kind of a risk asset. And we're getting closer and closer to achieving some targets in the oil. Where are you, oil? Here we are. Looking for 58. Okay, another $3 or so from where we are here. I think that this might end up being a great entry for the long side of oil. 58 doesn't hold, then the bull picture is going to be more in question, but I'm going to have to give it the benefit of the doubt that this is just a pullback in an ongoing mini bull market. Lots of problems in the Middle East. Wouldn't take much for crude to soar back towards $70, $80. So looking at that, I just want to let people know that haven't seen it before that at ForexAnalytix, the team spends hours upon hours accumulating research, support, resistance levels, all kinds of looks. You'd have to subscribe to several different sites to get all of this different type of analysis. So say you were interested in pound Aussie, Okay, and this is basic technical right here. Here's a basic technical look. But say you wanted to get an Elliott look, then you'd get Greg's stuff, right? Say you wanted to get a candlestick look, you'd get Stephen Blake's stuff right here. Say you wanted, you know, you're not a day trader, you're a position trader, and you want the macro on it, you get Stelios's work, okay? And harmonics, we're welcoming Anthony Crudell to our team. Looking forward to working with Anthony. So you'll be getting harmonic works. Normally you'd have to subscribe to at least a couple services to get all these different methods to be able to compare to see if there's confluence between the two. And then I also want to really stress how important it is. Oh, yes. Hi, Steve.
Sorry to interrupt. Andre Cardozo is going to be with us.
Who?
Harmonics. Andre Cardozo.
That's what I said.
No, you said Anthony Crudell.
Oh my gosh. Okay, Anthony. Okay, thank you. I have many senior moments. All right. Yeah, Anthony Crudell. He's a different guy. He's a host. He has a radio show. All right. So thank you for the correction. And you know, people that attend our free webinars, we give you about an hour of coverage, and then I have an interview with a guest to edify the community, bringing in different views. But see, you have Blake in here, you have me right now, you have Amanda runs our chat room in here, Stelio, Steve hangs out. So if an hour of free analysis isn't enough, I strongly recommend you at least take a trial here on ForexAnalytix. It's really a great value. You know, we have the link here in the webinar. The offer is, I think, outstanding. So to test drive our traffic light page, you pay $1. And I think we also have a phone app, so you're not tied to your workstation. You could go about living. You could even take all of us on vacation with you and, you know, put it in your carry-on luggage, and we'd be happy to go to exotic places with you and keep you aware of ongoing events in a lot of different markets. So with all of that being said, I've been around, and this is the strongest team I've been part of in my whole career. I've interviewed a lot of almost everyone on the team when I was at FX Street. Many are award winners, appreciated by the public, well-known, credibility, and talented in the market. So I have an expression: surround yourself with traders better than you. And I would say that the composition of the ForexAnalytix team, you're going to find at least one or two, even if you're a good trader, that are as good or better than you, and you have more than your two eyes working for you. And that's another advantage of the chat room, is that normally we have about 100 people in there, and we have 105 in here. So you have 210 eyes working together, supporting each other, sharing ideas. If you have a question and you're following someone here in this private chat, everyone's willing to support and share. And it's a real true community. It's like a family, a big family. It'd be a big table at Thanksgiving, but it is a family. So this is a real big advantage of being a subscriber. So give it a shot, invest in yourself and your future trading performance. And with that being said, great call yesterday, Blake, on the short side of Euro. I actually, you know, was not dollar bullish yesterday. And after hearing you, you know, it's something that most of us don't think about, Blake, is that when we have an idea and then you hear someone whose work you respect, and it gives you pause and helps you avoid a bad trade. It doesn't show up in your account, but man, is it important that if you're, you know, can be shown some other evidence to sway you against what you were going to do, can really make a big difference in your performance and save you a lot of heartache. So great call yesterday in Euro, buddy.
Thank you very much, Dale. Appreciate it. You know, yesterday was one of those rare reads where the market, I think the price action more than anything was suggesting that the dollar was going to rally. And I mean, there's a few. I want to take you over to the dollar index. You had to look at like the price action from the previous day in the dollar. You know, when we had this, we knocked our head right up against, and you can't see it here, but it was right up against 90, which was pretty key for me. But we just kept nudging right up against it in the dollar index, and so it felt to me that it was time to squeeze a little in the dollar. And I don't necessarily think the dollar is done. And the euro is approaching support right now, and you know, we've been talking about this since yesterday. Whoops. You know, once we cracked this green line, it was that was the kind of tell for me yesterday. But the euro is approaching this uptrend line. You can see it right here, and I think that's where we're headed, which is just below 122. Now, does that make me a euro bull at this point? I don't know. I am more concerned at this stage in the game, not about the dollar perhaps, but more the S&P. And the reason why I say that is because I have been arguing for the last I don't know how many months now that I don't have any good reason to buy the dollar. Like, I don't, you know, give me a reason to buy the dollar. I can't find one. I just, you know, it's like yields are going up, but the dollar has diverged away from that, you know, relationship for so long. I'm like, yeah, well, that's not taking hold. Although yields are still very strong, which I think the dollar's kind of taking notice. But I think what's really more taking notice is stocks, you know, and we saw that early this week. The stock market, you know, on Friday and then on Monday really took a big down leg with yields moving higher. So with yields continuing to move higher, the risk in the stock market is that we push back down, and if we do, that is the catalyst, in my opinion, could be for a stronger dollar with stocks weak. And that is, I think, the risk currently for the dollar. I think that the dollar is currently, you know, at risk of continuing to rally if the stock market continues to stay weak. So will the euro dollar stop here? Will the euro dollar stop at 122? I have to, if we get down there. I don't know the answer to that question, but I will tell you that I'm not going to make the decision whether I buy the euro or not when we get down there unless I see what is happening in other markets. We're getting to a point where okay, let me backtrack the last few months. The last few months, the FX market has been very immune to the stock market rally. Okay, what I mean by that is we've just kind of ignored it. The FX market's kind of done its own thing because the FX market probably sniffed out the fact that stocks were in a one-way, you know, freight train bullish move higher. Yet there wasn't any, you know, we all knew in the FX market eventually it was going to, you know, start to see some selling, and you know, things were going to change. But the FX market has just kind of been ignoring the stock market for so long because of the one-way nature of the stock market. And currencies are not, they could get directional from a you know, a single currency standpoint. They could be directional. We saw the dollar basically weak all through 2017, but we get to a point where, you know, the dollar gets so weak, too weak, or the euro gets too strong or too weak, or whatever the case may be, where the market needs to take a breather and it needs a reason for a reversal. So the last couple of months, the dollar, even though it was still moving lower, we've we haven't had a correlated reason why. But now that the stock market is starting to show some signs of potential weakness, the dollar might show some strength from a risk aversion standpoint, and that's why and it makes it tricky. I'm not going to lie, it's a very tricky trade at the moment. What we do with the dollar and how we treat it, and it's not clear. I wish it was so clear, and it's just not. We're in a situation where things are a little muddy at the moment, but stocks continue to recover overnight. Here's the S&P. You can see what the S&P looks like right now. We're getting a little hammer, and but notice where here. Let me do a little bit of work with the S&P. I'm going to actually take this fib and I'm going to make it a little different to give it a different look. Okay, so the S&P. Let's talk about it for a moment. All right, you see this fib. This is all of January, basically the end of December when we bottomed, okay, to the highs. 161% extension, we bounced. It also was previous channel lows right here, 200-day moving average. We got a huge bounce, obviously, in the S&P. Great. All right, so now the S&P has, that I don't want right now. The S&P, you can see here, had recovered basically 50% of the move, and now we're stalling. Now, I've been looking at this morning, and I'll just do this for you. You can kind of see it here.
Your buddy wants you to start cooking the rice and get off the charts. I heard him.
Huh? What's that?
Your dog. He wants you to stop talking about the markets and cook his rice. I
don't get it. Oh, no, that wasn't my dog. That wasn't my dog.
Oh, okay.
Yeah. No, the only dog you can hear from my microphone right now is the Bank of England's Mark Carney, which I'm listening to the. Well, I'm not listening to. I have the press conference up, but I'm not. I'm actually talking. I'm focused on charts right now. But no, my dogs are still sleeping. So anyway. I was like, what the hell are you talking? I didn't even hear what Stelios was saying. Anyway, so what we got here is a possible head and shoulder pattern potentially in the S&P, but what we have to see obviously is how stocks are going to respond today. Today is going to be pretty important. I think we have the budget deal that's looking to push through, and we could get the buy the rumor, sell the news. We could get the market looks at the budget deal and saying, oh my God, where are we going to find all this money that we're looking to spend on infrastructure and the opioid crisis and blah, 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 and maybe turn lower. Who knows? But I think the stock market needs to be watched carefully, because it looks like this rally, the rally that we've had the last few days, has stalled. And that is currently, I think, the risk in equities. It's like, okay, well, where do we go from here? This, from an Elliott wave perspective, and I'd like, even though I'm not going to be here, I think you should ask Grega Horvat if he shows up today, which I think he's going to. If that was looked at as an impulsive move in the S&P, which I would venture to guess that this was. So being that it was an impulsive move, chances are that we're going to get some follow through back, at least to retest these lows sometime in the very near future. So I think the risk here is like, holy cow, do we come back and eventually retest these lows? And I think that is going to be more of the risk in the market at this point in time. So anyway, if that is the case, does the dollar pick up a little steam as a result? Now we are seeing a recovery in the euro. Let's take a look at the euro dollar right now and see what we've got. So the euro is bouncing back after having a fairly rough evening, rough go at it. I think any move back up towards 123 is going to be, this is all going to be a very tough resistance for the euro on any rally back. So I think you should keep an eye on the euro if we head back up towards here. I actually was at a baseball game yesterday, and it was 45 minutes away from where I live. It was my son's baseball game. I shorted it at shorted the euro. It was a late game, and I was really far away from home. I shorted the euro 122.85 on the way home, and then I closed it. Actually, I closed it right here at 55, where 52 I think is where I closed it. I closed it like 52. Like an hour later, just before I went to bed, and so the bottom basically fell out of the euro really quickly. And I think that is the risk right now. When you're looking at the euro, it's changing its dynamics. You have to imagine there are a lot of people and a lot of traders and a lot of institutions that have been caught on the long side in a poor price. And that was my point yesterday. There are a lot of people that have been getting long the euro on this breakout from 122 all the way up to 124 and change. So the risk was a push back below support and wash out some of those traders. And I don't know if that washout has been completed yet, but I do think that we're going to eventually make our way down to 122 or 121 and change, and really test the waters down here and test the validity of these buyers, of the traders that are long. Remember, the dollar index has been beaten with an ugly stick for so long that it is at risk of a reversal. And like I said, I really look at the dollar index and I don't see it as I got a whole lot of reasons to be buying the dollar index. Technically, while the dollar is trading below this trend line, we've talked about this trend line for months. I think I've had it drawn literally since we peaked up here in November. As long as we stay below that blue trend line, there's really no technical reason to be long the dollar, at least from an aggressive position standpoint. Are we going to get, and I've played the dollar on the long side, several times the last 2 weeks, and sometimes very frustratingly, but I've overall done pretty well, just picking up the dollar on the cheap as we were down here testing this confluence of support. It's this big 618 retracement of the 2014 low to the high. It's a 618, 161% extension of this part of the flag. So buying down here in the mid 88s was the right thing to do, even though it was very frustrating for a week that I was doing it. The last few days have paid off very well, and I think we're getting to a more trickier area as we get back into this resistance zone. So as we go from 90, where we're currently at 90 and change, to 92 roughly, this is not going to be easy. All of this is going to be very very tricky, and if we make it all the way back up towards 92, this trend line, I'll be looking to reestablish dollar shorts unless we break out, because like I said, I don't have any real good reasons to be long the dollar. When you look at from a fundamental standpoint, central banks are all tightening. Listen to the Bank of England today and listen to how hawkish Mark Carney is. I mean, these hawkish comments are only only telling us right now that central banks are going to be continuing to raise rates as the Federal Reserve is looking to perhaps we already know what's priced into the market, and will the Fed maybe ratchet up expectations to 4 rate hikes this year? Perhaps, but that's not what the market is seeing right now. And most of the market's seeing 3. So unless we start to see interest rate expectations change here in the U.S., the dollar is, again, I think it's going to be a sell on rally. But again, where does that take the euro? I mean, does the euro drop back to 122? Does the euro drop back to one? I'll tell you one place that I am buying the euro no matter what, and because you're going to get a reaction from here, is going to be this 121 level. If the euro gets down to 121, I hope it does, because I want to be a buyer. I want to buy the euro dollar at 121. I just don't know if we're going to see it, but if we do see it, I know there's going to be a reaction, whether it's the buy it at 121 and it goes to 126 next, or does it just hit 121, bounce back to 122 and fail? I don't know, but I know we're going to get a reaction at 121. So that is where I'm really willing to step in and take in a euro long. But it is going to be a little trickier from here. I don't think it's going to be super easy. And with that being said, I think you have to be a little bit more nimble. Especially after yesterday's move. Yesterday to me was a fairly easy flush of euro stops, but now that we've done that, and now that we've flushed out a lot of those traders that were maybe positioned poorly, what we do from here is going to be a little bit trickier. I think maybe selling the euro at 123, buying it down at 122. I think that you just got to trade the range for today. So and just one last thing before I turn it over to Steve. We have unemployment claims, but really no other data is going to be driving the markets today. So I think just keep an eye on equities still. I think equities are going to be the key component of what we're doing today. With that being said, I'm going to pass it over to my colleague, Steve. Yes, Steve.
Good morning, first of all. I can confirm that Greg is going to be with us for like 15 minutes. So,
Great.
We're going to be lucky to also have his Elliott wave perspective on what we're looking for here. Just wanted to ask you a question before you go. You've obviously noticed, there's no question about it, that an inverse correlation between the dollar and stocks since we started falling. I mean, for example, now dollar is falling and stocks are somewhat recovering.
That's a relationship I like, Steve. I mean, like Blake said it, the dollar was down all last year. The market was up all last year. I think the stronger dollar is a headwind, and the weaker dollar is a tailwind. So,
to be honest, Dale, I think that the stocks are falling because they're afraid of what bonds are showing, and I believe that this inverse correlation, first of all, begins by the fact that any move higher in yields, so lower in bonds, so in essence higher in dollar, scares the market. So do you think, Blake, that the market having to do with risk is still completely focused on what's happening with the yield curve and
yeah, I mean, but look at yields this morning. I mean, they're generally speaking here in the U.S. they're stronger. Stocks haven't cared at all. The stock market continues to grind higher this morning from the lows. So, but I do think that as conditions tighten globally, I think the market's going to eventually take notice. Whether today's the day or not, it's to be seen. But I think the higher these yields go. I mean, we have the 10-year that's trading around what? Let's see, 285.
Yeah,
285.
Yeah, 285. Yeah.
Yeah, I mean, 285 is pretty, hefty. I mean, everybody's always talked about 3%, and we're coming close. So
look how they pulled back to the breakout on the crash day and then turned. That's your line in the sand for yields now, I think. See that pullback when we were crashing right back to about 265. Those were previous highs. That's a real significant area.
Yeah, and if you project this this move lower after the first initial buying, you will see that in essence, even if we have a quality of legs higher to yields, that's projecting like more than 3.3%, right? There. So, and to be honest, you know, this looks like a bullish break here, and you know, the momentum is strong. I think yields are moving higher, but you know what the fun part is that we are stuck in a conundrum in a sense, because on one hand, stocks are afraid of, let's say, a bond bubble bursting because yields are going to be moving higher, but on the other hand, every time they panic and risk is moving lower, bonds are strengthening. So in a sense, you know, we are tied up in a conundrum, as I said, and it's not going to be easy, because as long as stocks are panicking, bonds will be finding a bid, especially, I mean, like treasuries and bonds, etc. And as long as they're finding a bid, even for risk, yeah, mate.
I'm sorry, I gotta get going. I just want to say goodbye. All right, see you guys.
Bye bye, mate.
Good hunting.
As long as the risk of you know, brings back bid to you know, to the safe havens, to the safe haven bonds, like the bonds.
Well, it's going to be interesting, I think, Steve. You know, and I'm in agreement with you that this is a correction that's bounced from Monday night's low in the S&Ps. I actually think we'll go to, you know, 2740, 50 before we start a C wave or a 3 in the S&Ps, and that's going to be interesting to see what the bonds do. If they start taking out 265 on a market decline, then yields will tame for a while. That's going to be a very critical number to see what happens on the next decline in equities, to see if yields could get back under that 265.
Having to do with equities, I think, Dale, that you know, the market seems to have stabilized. So yeah, you know, we're definitely not in panic mode. Regardless, I consider almost impossible to see something like this. I think that the market is going to, I think that the market is going to be quite scared at the moment. I think that there are a lot of people that, after getting that first scare that we saw, are going to be like, okay, you know, that was a good run. At the very least, I should be, you know, paring down positions. And even if the market is to remain extremely strong, I think that the best it can produce for now as a bullish scenario is to give us something like this. So consolidate somewhat in time, perhaps in a triangle. Worst case scenario, get a move a little bit lower, so like get a rejection, move lower towards, let's say, this area of support, like you know, and then move for more upside. I think that we might find ourselves being range bound for a decent amount of time from this point on. And in my opinion, people should be careful not to get trapped. I think that for some time at least, selling the rips, for example, you can see that in action yesterday. I mean, the market yesterday retraced like more than half of the drop, and there were a lot of people that were like, okay, you know, this is a good exit area for me, fine, you know, let's go ahead with it. And that's why we got a big intraday reversal yesterday. We might see some more strength, but I believe that, you know, sellers are actually going to be stepping in, and people that want to be hedging and people that want to be reducing bullish exposure. So I see a very high possibility of a market that's going to be choppy for at least like 1-2 months, especially given the prior, you know, non-stop uptrend.
Yeah, well, I'm looking for about 2760 to be a seller for a retest.
Did you hear Gregor?
Yes, I'm here.
Ah, there you go. So what do you think on the subject, since we were already speaking about that? What do you think about this, Gregor, that I just said?
I'm looking at this Bund chart versus euro-dollar, and what I see is that since 2008, we have been in a very strong bull market, as you know. And since 2016 we are in a corrective phase, and as we go down on bonds, euro-dollar has moved to the upside at the same time, and what I see on bonds is a potential just temporary pullback. So a new resumption higher on bonds or 10-year US notes prices, I think, could send euro dollar to the downside, which means dollar could strengthen.
Yeah, but we were talking about risk. I agree with you, but speaking about the boons,
during this, when this will line up, then I think that stocks will be again ready to continue to the upside. Because I see, technically speaking, I see clearly in just a temporary corrective wave 4. But it's as you said yourself, it can be a sideways price action for a while, which would actually make sense. But we have to consider that there will be a third leg down, either wave C or something else. So on the downside, maybe downside is not done yet. You know, it can be
because I guess you don't have a full count already. I mean, to me, this first wave of selling that we saw here looks clearly impulsive. So I'm guessing what was that? Probably a 5-wave A. How do you count it? Let me give you the screen, by the way, so you can show us.
Yes.
There you go. Now you should have the screen.
So actually, what I'm looking at here is that yes, we are in a potential wave B already, so we completed wave A, or we are maybe just in a wave 4 of A still, looking to the downside. But in either case, I think that there is a very slow and overlapping recovery if we go to the smaller time frame, which indicates that this is a corrective movement. So it can be wave 4, it can be wave B. In either case, I think that next leg should be to the downside.
But in either case, Greg, I'm guessing that it can be a flat correction. So bottom line, I mean, we can't even exclude the possibility that we've already seen the low of this corrective move, right? I mean, we might have seen it, right? There is a chance.
Yes, of course, there's definitely, it has been proved to be correct that any spike to the downside was fully reversed quite quickly. So, as you know, because of a lot of fear, a lot of traders will go out and actually market will move in the opposite direction. So we have seen such reaction here in June 2016, then here in November of 2016, you can see that very strong move occurred to the downside, but then market quickly recovered. So as you said, definitely could be low of a wave 4, or maybe we go in a triangle. But the idea is that we are just in a temporary pullback, I believe. I don't think that we are going to see any significant bear market yet.
But you do think, if I remember, that the next high is going to be terminal, right? It's going to be wave 5 to the whole uptrend, correct?
Yes. What I'm looking at is that we are now in potential this black wave 4, and for final push up, I will look maybe even towards 3,000 to complete this cycle. Also, if we take a look on DAX, I'm tracking here a flat correction, or it can be wave 3 finished here. Okay, and we are going down for an ABC towards 38.2%. But in either case, I think that this is just a temporary pullback of this incomplete, still ongoing cycle within larger degree. Red wave 5 that has these FIP targets here of 261.8% extension of this first leg. This normally represents the end of this whole 5-wave movement, the whole cycle. So I take this.
I'm guessing that you have more or less a similar view for Nikkei.
Actually, I don't have the count on Nikkei here.
Okay.
But and also I'm looking at this 161.8% extension of this wave 4. So overall, I see room definitely for much higher levels here after this wave 4 finishes. But on the intraday charts, we see as you can see here, very slow and overlapping recovery. Okay, so I assume it's not a turn yet, and it's probably just a pause with an ongoing weakness, which could resume after we hit resistance here at 12,746. So actually, for the near term, I think that stocks could come under pressure. And that's why I actually issued a long Euro Aussie, as you know, with the PIP. So the reason why I took long Euro Aussie is very simple, because I think this is risk off trade. Okay, so if I clarify this, let me pull out this chart. Okay, so since when stocks turned to the downside significantly here in at the end of January, at the same time, okay, in the same hours actually, Euro Aussie started to rally very significantly, strongly to the upside. At the same time, as you can see, stocks fall. And what we have seen after our nice recovery and turn up on stocks, Euro Aussie is not going anywhere to the downside. It's just
in a triangle. Yeah,
yes,
it's in a triangle.
Trapped in a range, which from an intermarket analysis perspective suggests that if Euro Aussie is not going to the downside when stocks are recovering, but it's going higher when stocks are falling, then my thinking is that the next leg on Euro Aussie wants to be to the upside, especially if also consider that stocks are showing evidences of a corrective pullback, as I said here. If we go back to the S&P 500 on the hourly chart, this recovery, okay, I don't have an updated wave count, but this recovery is looking overlapping. So I assume that this is corrective move, and next leg will be to the downside. So with that said, Euro Aussie could then easily explode to a new high. Also, if we take a look on the euro dollar, okay, what I see here is just a temporary pullback. We tested the area of support of a former wave 4. This is a perfect region from where I would love to see a continuation higher. And not only that, if we take a look on Aussie, because it's a Euro Aussie trade, if we take a look on Aussie, what we can see here is a clear impulsive development, bearish development. It suggests that we will see more weakness because decline is impulsive, and any pullbacks will be only temporary. So we have stocks that are probably still in a risk off mode. We are seeing corrective bounce. We see euro dollar in very nice still bullish pattern. We see Aussie dollar in a bearish pattern. So all in all, it suggests that Euro Aussie should continue higher. And if we take a look then on the Euro Aussie, then we need to ask ourselves what's the wave structure on the Euro Aussie. And here I can clearly see that if I label this chart, this is wave 1, 2, probably an extended wave 3, and now this wave 4. Maybe wave 4 was finished here, maybe, as you said, Steve, it's a triangle. But in either case, the idea is that I want to trade in the direction of a trend, which is clearly to the upside. I want to take a trade in the direction of intermarket analysis, what other markets are confirming. And combining everything together, Euro Aussie stocks, Aussie dollar, then clearly I think that Euro Aussie is probably the best trade at the moment that I see in the market. That's why I also decided to go long PIP.
Yeah, big minds think alike. Yesterday, Abdul was asking about the one of our everyday listeners was asking about the euro and pound crosses, and after going through all of them, I said that in my opinion, the best setup among them is probably the euro Aussie long. I said the exact same thing actually.
Yes, because it's a very nice looking wave structure, I believe. So.
Yeah, and in general, I prefer longs against the Aussie than against the Kiwi.
Yes, it's much.
And we've already seen a big move today higher in the cable. I think that there is quite a big possibility that we're going to see some headlines from the ECB as well, and euro is going to follow suit. So I'm also not buying into the weakness of the euro as a bearish development yet. I mean, I would need to see a lot more to be persuaded that the euro and the cable have turned to bearish, simply because the moves lower have been, slow. They haven't violated any technical levels, right?
Yes.
We have a friend asking here for oil, and by the way, Abdul, I did receive your email. And I'm going to answer to you today because one of us is going to be in London a few days afterwards. Anyhow, I'm going to send you an email later. Okay, my pleasure, mate. Sorry, but I've been extremely busy. I told them yesterday that crude, I was saying for a lot of days that crude is looking to me like it wants to make the move lower, and that a break below 63 could easily bring it back to 58. We're seeing some very nice follow through today. I know that you've also been tracking it like really closely. So what do you think about how close are we to this correction ending? Because I think at a very bad scenario, it can even go down to 55. Although, to be honest, 58 was my preferred target to be looking lower.
Actually, I'm looking on crude oil, I'm looking at two potential support levels. But before I go to this, I want to highlight that I'm still bullish on crude oil, and simply put, it's because we have an incomplete 5-wave bullish cycle from June of 21st or so. So I'm waiting on 5-wave movement to unfold. We have seen a nice looking corrective setback within corrective pullbacks within this extended wave 3. They were very similar in shape and in distance as well, as you can see, even in time. So I'm expecting something similar to unfold here in this wave 4 of a higher degree. Also, we have seen here wave 2 pullback, okay? And now we are tracking wave 4 pullback of the same degree.
So you think the two corrections might have equality, right? I mean,
yes, it can be very equal, but there's something else. We can see very aggressive move to the downside, but the dollar cat is recovering in 5 waves. So what makes me thinking is that we are maybe in more complex wave 4, and actually this means that we could see a little bit deeper pullbacks, and I would not be surprised because just from clear Elliott wave perspective, and if I respect the guidelines, when you have an extended 5th wave, if we look at the red wave 5, when you have an extended 5th wave, the price action of a wave 4 will not retrace back to the end of wave 4 of 1 last degree, which was at 55.80, but rather to the starting point, which was at 58.70 or 59. So if we consider the dollar cat has 5 waves up, which means likely we'll see more gains. So during this time, crude oil could either consolidate or even see a lower pullback here, or maybe these two markets can, as you know, simply break up the correlations, and every market will go its own way. That's also possible, as you know.
Yeah, for some days, of course.
Yes, but as what I see now, I would not be surprised maybe to see even 59 and then push to the upside. But definitely, I see this as a wave 4. Okay, when dollar cat makes a pullback for wave 2, wave B, we may see final push up for a wave 5, and then big reversal to the downside could cause big recovery in dollar cat.
I don't know what is your target for USD CAD. Personally, I said since several days ago, since we got that big reversal on Friday, last Friday, 6 days ago, I think that 126.60 is a good target to be looking for resistance, because it was the support area of the former range that held us there trapped. So, but from what I see, you have much higher targets, right?
Yes, as you know, I have been repeating this flat correction, even if it was a very deep. I said the 78.6% retracement of wave A is normally the final zone where I want to see a reversal. And we have seen a very nice reversal and very strong so far, which came out of this ending diagonal. So it was a very clear pattern in this downtrend that suggested we will see at least 3 waves of recovery. But so far, there's still only 1 leg to the upside. And we just hit 1.2590 resistance of a wave 4. But since this is an impulse, this wave 4 region will sooner or later be broken, either after a pullback or maybe even earlier, and then this level will turn into a support. So I think that dollar cat
is in buy the dip mode.
Yes, definitely. I think that we will see more upside. I also issued PIP when we were trading around 123.90, I believe, and the reason was clearly because of very strong move to the upside out of a ending diagonal. And we know when ending diagonal is finished, market will retrace normally back to the starting point of an ending diagonal, which was exactly here. So we should be aware now of a pullback and then ideally next leg to the upside. And normally, when you have an impulsive price action, not a free wave movement, but an impulsive price action, which is a very strong move into the resistance zone of wave 4, and then you get wave 2 pullback, that aligns perfectly with a head and shoulders formation. Okay, so
yes, you're absolutely right about that. We can easily get this being a head and shoulders formation, correct?
Exactly, but normally I said several times that head and shoulders formation goes in line with the Elliott wave theory only if you see into this neckline an impulsive reaction, not in free waves. That's because if you know Elliott wave and you know head and shoulders formation, then you can somehow decide which head and shoulders formation can be very good and which not. Because if we would see only a corrective movement towards this level, then I would not be looking for head and shoulders formation, because it would not line up with an Elliott wave theory. It doesn't mean it's not head and shoulders, but it's not very good.
We started by checking. Yeah. I'm totally with you. We started checking several things, but I remember that all of us were looking for the DXY to find support at 88.50 roughly, because we had several confluence of supports there. That manifested, obviously. The question is, what is, because we have to start by broader things. So what is currently your count? What are your expectations currently for the DXY as an index to move from here?
Same thing like euro dollar. It's exactly the same thing. I still think that euro dollar is the one that is having a very strong impact in dollar index in general, and it will confuse. Yes, and it will confuse a lot of traders. Even if euro dollar goes to a new high, only euro and no one else, it's still dollar index will be to the downside. So if you really think that dollar index is just in bearish mode and that dollar is just bearish, I still think that best trades are euro dollar longs and not some commodity pairs longs or whatever, because it's just not such a good structure and not a clear trade. And
so
what I
see very likely that even a new high in the DXY is not necessarily going to come with real strength across the board for the dollar, but perhaps it might be more focused, let's say, on the euro and on the cable, which in combination, the two of them are a huge part of the DXY.
Exactly, and this has been proved several times in the past. So what I see here is actually that we are in a perfect resistance area. It's a clear wave count. Even from a textbook, you cannot have clearest wave count. Okay, you have a very strong first reaction to the downside, then a pullback, and then an extended 5-wave decline through these trend line supports. Okay, this is a parallel trend line. So this breakout indicated that we are in a wave 3, not some kind of a wave C, because strongest price action is always wave 3. So anyone who is counting waves, who is watching this webinar, you should know how to draw these trend lines, these channels, because these are very helpful. Not only that it helps you to identify that you are in a wave 3, but will also help you to identify end of a potential zone for a wave 4. Normally that's at these trend lines. And notice that we have this trend line coming exactly at the area of a previous wave 4. So a lot of noise was around there, and normally this noise means it was a lot of transactions back then. It means it can be, again, very important level for potential reversal. We are also at 38.2%, and also wave 4 was very similar in shape, as you can see, compared to wave 2. So technically speaking, I would not be surprised to see dollar pushing to the downside.
Any alternative counts? I mean, let's say that both Blake and I have said that if the DXY breaks above 91, then people might start getting really squeezed. So let's say that.
But what means breaks above 91 is resistance here. So breaks towards 91, 30, 40 would not be enough from my point of view. What we would have to see is a break above this trend line resistance. Connected actually from 2000
at roughly 92.
This, if we go straight up from here, it would 92.40. I would probably focus on this invalidation level. It's also 92.48. So very close actually to this trend line. Okay.
Although, if you want my personal perspective, I think that if we break above 91, it's not going to be at all easy to stop the unwinding of positions, because, as you know, positioning is already extreme. So I think that, you know, if we get rejected from here, absolutely fine, perfect. I mean, from a technical perspective, perfect. But if we start pushing above 91, I think it's not going to be easy to stop the market afterwards, because there's going to be a lot of positions to unwind there.
Yes. Also, today's Thursday. Tomorrow we should see what will be the close. If we'll see,
you're right.
If we see a retracement, let's go to a smaller time frame. I can do that. Okay, I will save this template. Okay, so we are now breaking the first swing low. Normally, as I said, let's assume that this is, if this is wave 4, okay, of some previous bullish trend, whatever. Then normally in pullbacks, market will stop of this at this area, at this wave 4. Same like here in downtrend, wave 4 finished here. So if we assume that market, that trend is changing, we want to see a decisive break through this resistance.
Or perhaps even that previous high.
Support. No, not resistance.
We also have that previous high on your left, Gregor.
Yes,
perhaps,
I know.
Yeah, perhaps that connects. Yeah.
So to confirm this reversal, what would I have to see is probably a deep pullback into this level. Let's assume that this is some kind of a wave. 1, 2, and you are bullish and expecting continuation to the upside. Then you know that if we see pullback deeply into this wave 2, any bullish interpretation will likely be invalidated. That's why I think that today and tomorrow's price action will be very important, because it will be much clearer whether this is only a temporary pullback or are we going much lower. But what I assume will happen is that we will continue to the downside, that market will stay weak, will also stay weak on Friday close. And if we can close, let's say, somewhere beneath 90, then I think that this would be a nice indication that market wants to see lower levels. Also, I would keep an eye on this trend line.
One last thing. What do you think about the metals?
Actually, gold is in a pullback, I think. We have seen a nice reversal into this support. So actually, gold seems to be tracking euro-dollar much better lately than Aussie dollar. So maybe this will see higher prices if euro-dollar will continue to the upside, and if dollar in general will dollar index stay weak, then definitely I don't think that there is much of lower potential on gold. Probably the base will form. Okay,
and I'm guessing you have a more or less a similar view about silver, but anything different there? Anything?
Yes, it's actually silver. It's actually the same. You're now 61, and
so your main case scenario is that they're closer to forming a short-term low than anything else.
Yes.
Okay.
Even if we take a look on this wave count, on this structure, you can easily count this in 5 waves to the downside as well, right? But normally when I analyze the markets, I will not only stare into silver, I will look at gold, and gold has a much clearer corrective pullback.
Isn't there a wave missing there? I mean, I see A, I see B. Isn't there a potential that C is a 5-wave move lower? So couldn't this be like a wave 4? Yeah, that has started now. Oh, you're counting that as a one. Okay, got it. Yeah. Okay. Yeah, I see it.
Okay, so, but what I wanted to say, even if we level this a little bit different, okay, which is definitely possible.
Like the wave 3 finishing.
Like
where you have
1, 2, 3, 4, 5.
Yeah.
I can make this work here. Okay, even if I count this 1, 2, 3, 4, 5, but even in such case,
We have a pullback first.
In ABC pullback. Okay,
and
so
then
in
one more leg of the downside.
Short-term bottom can be formed here.
Okay, if you have a few seconds, because we have the interview, our friend Michael's asking for your view on copper, and then we'll have to wrap it up because Dale has an interview.
Actually, I don't have copper, honestly.
Okay, well, Greg, I want to thank you for crystallizing my view on the dollar. I was in the minority before you came, and thank you for mentoring Steve on Elliott Wave again today. Great job, buddy. Thank you so much. Thank you, Grega.
Thank you, Grega.
Bye-bye.
All right, thank you, Steve. Are you starting to get the hang of Elliott now, Steve? All right. So we have Brent Johnson with us, guys, and you know what a great segue. You're talking about precious metals, and Brent has a fund, and I'm going to make him the presenter now. Looking forward to speaking with Brent. Okay, Brent, I'm passing you the baton, so I'm looking forward to hearing your voice, and I'm not sure you have anything you want to show on a screen share. If not, I'll take the screen back, but it looks like you do.
Yeah, can you hear me okay?
Can hear you fine, Brent.
Okay, great.
Very nice to meet you.
Yeah, great to be here. Appreciate you having me on.
And also a very good time to be talking about precious metals. And before we start talking about the markets, I know what you're doing now. I'm always interested in what people's entree to the business was.
Yeah.
Can you take us back and tell us how you ended up at point B? What was it at point A that got you into the industry and had you gravitate towards the PMs?
Yeah, sure. So I worked at a firm called Donaldson, Lufkin and Jenrette starting in the late 90s.
Okay.
And went through their training program on Wall Street for their high net worth group or their private bank, however you want to label it. Shortly after I started with them in New York, I moved to their office in San Francisco. And shortly after arriving in San Francisco, Credit Suisse bought Donaldson, Lufkin and Jenrette. So I spent 10 years with Credit Suisse in the San Francisco office.
Nice.
And overseeing clients for the firm, high net worth clients from the Bay Area. And I could make this a very long story, but I'll make it a short one. Is that in 2007 I had a meeting which really opened my eyes, and that was this young couple had sold their video game business for $30 million, and I met with them, and we kind of hit it off on a personal level, and then we kind of got around to their talking about their finances, and I invited them to come into our office in San Francisco, and I said, you can meet the whole team. You can meet the chief investment officer and our head of equities and our head of fixed income. And so we did that. We invited them in, and we had this beautiful office overlooking San Francisco Bay, and I ushered them in there, and we had all these managing directors there that I thought were just going to wow them. And this young couple proceeded to very politely just tear them apart with questions that the managing directors couldn't answer. And about halfway through the meeting, I realized this wasn't quite going the way that I thought it was going to go. But the managing directors were just so clueless to their own, BS, for lack of a better word, that they didn't even realize it. So, the meeting wraps up, I walk the couple to the elevator and they leave, and we agree to keep in touch and stuff. But I knew that they were not impressed with our team. And I walked back into the conference room to kind of break it down and kind of ask them, what happened, why weren't they able to answer these questions? And they were in there laughing. They said, this young couple, they made a bunch of money, they think they know everything, they don't know anything. And I left that meeting just thinking this isn't the way it should be. You couldn't even answer their questions, but you're the ones that thinking that they're the ones that are dumb. And that was a real eye opener for me. And in that meeting, this couple had proceeded to ask questions like, talk to us about the derivatives on your balance sheet. What's the national debt? Are you worried about the national debt? What's the real rate of inflation versus the stated rate of inflation? And they weren't really that hard of questions, but they were, I guess, obscure enough that, these guys just kind of didn't think they were important. And so I went
Well,
back
maybe,
to my,
maybe that's a testament to those people in those positions.
yeah.
It's not what you know, it's who you know.
Yeah, right. And so I went back to my desk and I literally got out a piece of white, printer paper basically, and a pencil. And I went onto Google and I looked up the national debt and I wrote it out longhand. And I looked up how much our tax revenues were. I wrote all these numbers out longhand. And I quickly realized, you hear these numbers and you don't really think about them, but you write them down and you see how many zeros there are, and you just realize that it's not going to end well. And I wasn't smart enough at the time to figure out that it meant that the banks were all going to crash, the following year, but I was smart enough to realize that it wasn't going to end the way everybody else thought it was going to end. And so, that was kind of the beginning of the end for me at Credit Suisse. And so when we went through the crisis in 2008 and 2009, again, I'm not going to sit here and say that I called it or that I, profited from it, but I kind of understood what was happening. And I guess I felt like I understood it a little bit better than everybody else around me. And once we got through it and we were kind of coming out of it, I, went back into the same, chief investment officer, the same head of equities, same head of high net worth, and said, what did we learn? What are we going to do different? And their basic answer was that, well, that was a really horrible 2 years, but it's past us now. It's back to business as usual. And that, that was kind of the last straw for me. So I left Credit Suisse and I joined a buddy of mine who had started his own wealth management firm, and I moved my clients over there. And so that's what I'm still doing. I'm at a firm called Baker Avenue Asset Management, where I do my diversified wealth management business. Okay. And then in around 2011, I also set up Santiago Capital, which is the precious metal solution to the overall pie for the high net worth, diversified wealth management business.
So are you now a registered investment advisor?
Yes. Yes.
Okay.
Yes.
Okay.
Yes.
And all the models really shifted from a commission-based business to asset-based business.
Sure.
To 2% or whatever it is. So I like your tagline: if you believe in math, buy gold. So you've seen quite a few cycles since 08 and 09. You've seen a bull market into 2011 or so. Wasn't at the peak at 1900, 2011. And now you've seen more of a trading range market. Declined from 1900 to 1050. Let me ask you this, even though you believed in math, how did you handle gold giving it back and a cycle shift? Are you always bullish gold? As it's a philosophy that you should have like 10% of your portfolio in gold related assets, no matter what the trend is?
Yeah, so long story short, I wish I had handled this last 5 years better than I did. I thought we would have a V-shaped bottom. It turns out we've had a couple W-shaped bottoms, and and truth be told, I'm not sure if we're ready to come out of it yet or not. I think that regardless of where you think gold is in the cycle, things are bad enough, if that's the right way to say it, or situation right now with the with the global economy is bad enough, or however, whether you want to use bad or not, I don't know if that's the right word, but you should always have an allocation to gold in your portfolio, regardless of what the situation is, because you just never know. It's like an insurance policy against the rest of the portfolio, really. And I think that at a minimum, I think you should have 10%. At certain times, I think you could have much more than that. I don't think there's anything wrong with 15, 20, 25% of your portfolio, assuming that the rest of the portfolio is positioned in a way, that can provide you liquidity and, et cetera, et cetera, et cetera. I'm not somebody who thinks you should sell everything you own and put all your money in gold. I do think it's very important. I think it should be the cornerstone of your portfolio. I can't really think of any situation where nobody should own it, or that you shouldn't have any in your portfolio. But I do think at one point gold will get into a bull market. It will go up a lot, and there will come a time to sell your gold and go buy something else.
Okay, let me ask you this though. There are many ways to skin a cat. There are mining shares. You could own the bullion and have it parked somewhere else. You could hold it physically and put it in a coffee can and bury it in your backyard.
Right.
What do you espouse? You know, I think that everyone should have it physical possession of some gold, and there are times when the miners underperform and outperform the price of bullion.
No, absolutely. So the way our precious metal strategy is set up is that we actually own the physical bullion. We own the bars. We have them stored in 3 locations around the world outside the banking system in private vaults. That's a little over half the portfolio. It's probably about 60% of the portfolio. It's always going to be at least 50%. Right now, it's closer to 60%. We also have the opportunity to invest in the mining stocks. We're not invested in any mining stocks right now.
Is that because a lot of them are kind of over leveraged and holding a lot of debt?
Well, that's part of it. You know, a lot of those they've done a really good job, I guess, I'd say in general over the last couple of years of cleaning up their balance sheets, cutting expenses to the as much as they can. And so I think when gold finally kind of breaks out of this, 5-year, 6-year bear market, that the mining stocks are going to be in better position than they have been, because they have done these cost-cutting measures. But a lot of people get mad at me when my friends in the gold world get mad at me, and when I say that gold's not going to 2,000 this year, and I just don't know if we're ready yet. If we are, that's great, and I'll probably kick myself for not have bought some of these miners at the prices they are today. And
okay,
I think if you have a 5 or 10 year view, then and you don't mind the volatility, I think you can buy them now. But I think there's going to be another opportunity to buy them a little bit lower, so that's why we don't own them right now.
Okay, and before I ask you the difference between like juniors and seniors, I have a great question from Kareem. Why Santiago? Did you do the Pilgrim's Walk? How did you come up with the name of your fund?
I did do the Pilgrim's Walk. I walked 500 miles across northern Spain. Took me 26 days. And after that, I went and laid on a beach for a week.
Okay, all right. And is that the reason for naming it?
That's the key reason. So my 2 favorite books, the lead character's name is Santiago, and then I did the Pilgrimage of Santiago. So when it came time to picking a name, I thought that was pretty appropriate.
Okay. Any other precious metals that you at times consider, platinum, palladium, silver?
Silver.
You pay attention to the gold-silver ratio?
Yeah, so that, I don't know if you can see my screen or not, but I pulled up
well, you didn't have anything up there. I'm going to give you the screen back now. I just put up the gold chart, but
let me find, I've got
the screen back. So
give me a second here now.
So share your screen again.
Let's see, where's this at? Here's the gold-silver ratio here, going back, a long time.
I need to see your screen again.
Sorry. Okay.
There we go.
You
okay.
Now?
Yeah, I got it.
Okay. So this is the gold-silver ratio going back, 30 years, 40 years.
Yeah.
And you can see if you can see my cursor, I've got some lines drawn on here. But from 90 to 99, that was a great that was a bull market. The gold-silver ratio was declining. And you get into 2000 and to 2009, it's declining again. That's what you should see. You should see gold falling against silver in a bull market.
Silver should lead, and it hasn't been. It's been lagging dramatically.
Right, it's been lagging. You can see for the last 4 or 5 years, it's heading up, and it's last year there was this. I'll see if I can. There was kind of a key level here last year, where I thought it was going to, come down, hit here and come back down, and it kind of broke through it, and now it's moving up to the upside. I would have rather seen it, come down this way,
right?
To indicate that silver is now outperforming. Once we get into the bull market, I think silver and the miners will outperform bullion, and they were for a certain period last year, but that's kind of switched around here in the last couple of months, and you see silver and the miners both lagging gold.
Yeah,
I think silver's down for the year.
Excuse me?
I said I think silver is actually down for the year now. The miners are down for the year, and I think gold is flat, basically maybe up 0.5%.
Okay.
I mean, we're early in the year, 26 weeks in.
When we saw the crash or mini crash or whatever, the sell-off in equities, were you surprised, disappointed there weren't more flows into precious metals early in the week?
Not yet, because a lot of times, a lot of people don't realize this, but gold is a great hedge against these volatile periods, assuming that they last. But if it's just a 1 or 2 day volatility period, a lot of times what happens is gold gets sold because people get margin calls, and that's the most liquid thing, right? Or if you go back to 2008, gold went down, I think 15-20% before it ended up being up for the year. But there was a point during the year where it was down, I think 15 or 20%. And, it was because when things were getting liquidated, gold was one of the things getting liquidated, because it's always liquid. There's nothing more liquid than gold. I put out this presentation a couple of weeks ago, kind of middle of January, talking about some of the different markets. And I said, the markets had come a long way. It was kind of breaking out, and that I wasn't sure we were going to. I said I would love a 10% pullback. I said I wasn't sure we were going to get it, because I think for a number of reasons it's going to continue to go higher. But I would love if we got a 10% pullback. And I guess the moral of the story is, if you say it, you better believe it, because you just might get it. And we haven't quite pulled back to this level, but it's pretty close.
Okay, so were you a buyer on that sell-off that we had into Tuesday? And I also wanted to ask you if you keep an eye, if you have a view on the dollar, since you're involved in precious metals. The dollar. So I
actually have I have kind of a contrarian view of the dollar. Let me get to that in a second. Okay. Regarding the market, we were not buyers on earlier this week, but we did buy some put options a couple of weeks ago on the S&P, which turned out to be a pretty good time, and we pulled those off earlier this week when the big sell-off came. So that was rather timely. We don't do a lot of that kind of stuff, but every now and then we will, and so that worked out pretty well. Regarding the dollar, I'm kind of I'll pull up a chart here of it. I'm kind of unique, I guess, in the gold world, in that I think the dollar and gold are going to rise together.
Okay, great. I rarely hear that. So tell us how that can happen.
Okay, so there's a couple ways it can happen. And I put out a couple presentations over the last 2 years that kind of explain how it can happen. I'm happy to send them to you. You can watch them. You can send them to your listeners, whatever you want to do. But long story short, I think that, in the same way that there's only so much gold out there and there's a lot of claims on gold, in a debt-based monetary system, it's kind of the same thing. There's only so many physical dollars out there. And if you get into a bank run, all these different claims are going for the limited number of physical dollars, and you can get a short squeeze on the dollar just the same way you can get a short squeeze on gold. Now, the difference between gold and dollars is that the government can print dollars, right? But they're not printing dollars right now. And I know a lot of people keep saying, well, they're going to have to. They're going to have to go back to QE4 or QE5 or QE6 or whatever it is. And they might. I can't say for sure that they won't. But right now, they're not printing. And in fact, they're taking dollars out of the system. So they're decreasing the supply of dollars, but there's still an amazing amount of demand for the dollar. If you add up all the dollar debts in the world, and you figure and you assume that the average rate of interest on all the dollar debt in the world is the same rate as the average rate on the US Treasury, there's still $1.2 trillion a year of demand for dollars just to pay dollar interest rates, just to pay dollar interest coverage. And the reality is that it's not all the debt in the world is not issued at the risk-free rate of 2.3%. It's probably double that. So there's probably $2.5 trillion a year in demand for dollars just to pay interest on dollar debt. So, and the fact that the U.S. government is not printing dollars right now means they're not supplying the market with the dollars that it needs. Because we're not importing as much oil as we used to, and we're not sending our dollars overseas, we're not giving the rest of the world that same flow of petrodollars that we used to. So we have a situation where I think demand for dollars is still incredibly high. Maybe it's not as high as it was 2 years or 3 years ago, but it's still incredibly high. But now supply is falling. And on top of all that, you have the U.S. government coming out now and getting ready to issue more debt than they've ever issued before. And a lot of people will say, oh my God, they're going to issue another $1 trillion in debt. That's going to kill the dollar. The dollar's going to zero. Well, in the long term, that's probably the case. But in the short term, if you have a limited number of dollars out there in the system, the Fed is not creating more dollars right now. And now you have the biggest buyer in the world, which is the US government, coming out and saying, we want dollars. We're issuing debt in order to get dollars. So they're basically buying dollars with their debt. You've got the biggest buyer in the world now entering the market where supply is already tight and they want more and they want to compete with the rest of the market. That, to me, that's a setup for the dollar to go a lot higher.
That's really an interesting view from someone who professes, you know, precious metals. And,
right.
you know, they say we have so many, most dollars are digital. Most dollars are digital.
That's
not
true.
Cash.
That's true.
And that's why a lot of people are hoarding cash, and that's why a lot of banks actually ask you questions when you go to the bank and say, well, I'd like to withdraw 5,000 cash.
Yeah, absolutely. Absolutely.
So
you know, I think long term, it's pretty clear that long term governments like to debase their currency, and long term, you know, the dollar will do like every other paper currency in history and go to zero. But right now, it's a relative world. You know, China's still providing stimulus, Japan's still providing stimulus, the ECB still providing stimulus. We're really the only market out there that's tightening monetary supply. And a lot of people will say, well, they can't keep doing it. They're going to have to go back to QE. Well, that may be the case, but they're not going to go back to QE with the dollar, the DXY at 90, right? If the dollar fell 13% last year on its own, they don't need to go in and weaken it when it's fallen on its own. So
they're not going to go to QE with the S&P at 2,800 either.
Exactly.
Maybe at 1,500.
Right. And so if the pain gets bad enough, then they will print. But I think if the pain gets bad enough, the dollar's going to go through the roof as well. So, you know, eventually the dollar will go down, but a strong dollar will just kill the monetary system. There's just too much dollar, and it will cause so many problems and cause so much chaos that I think the rising dollar will cause gold to rise with it in the chaos. So that's kind of, in a nutshell, that's kind of my theory.
Okay, so why don't we wrap it with the new wave? What's your take on crypto?
Wow, that's a great question. So, you know, it's kind of I'm going to tell you a story here, and it's not an unemotional topic for me because somebody sent me the original white paper back in 2010. I read it in 2010, and I'm not a technology guy. You know, I live near Silicon Valley, and I have a lot of friends that work in technology, but a lot of it goes right over my head. And I remember reading this paper, and I remember thinking, if this technology actually works the way that this paper says it works, in a million years, it'll never be legal because it's just way too powerful. And I remember thinking, I should put, it was 25 cents at the time. I remember thinking I should buy $5,000 worth and just forget about it. And I didn't, because I was absolutely certain that the government would outlaw it because I thought it was too powerful. So I'm a big proponent of it. I think I think everybody should own some. I own a little bit. I don't own nearly as much as I should. And, you know, had I bought that at 25 cents when I thought about it, we'd be calling you from
be a billion.
Branson's private island or something.
Right.
But I do think it's
be like Brock Pierce.
Say that again.
Be like Brock Pierce.
Yeah,
the
exactly.
Bitcoin billionaire.
Yeah. I mean, I do think digital coins are here to stay. You know, anytime you get this much money flowing into one area, you're going to get some bad actors in there as well.
Right.
And I think Bitcoin, as it's designed to be used, is not actually the way it's being used now. So I don't think Bitcoin itself is a Ponzi scheme or a bubble, but I think there's a lot of Ponzi actors and a lot of bad actors that are trying to use Bitcoin in nefarious ways. So you got to be very careful. But long term, I think Bitcoin is going to go higher. I think it'll probably be somewhat similar to the internet, where 90% of all these coins and ICOs and tokens and will end up going bankrupt.
Yeah, like the dot-com bubble.
Right. But there will be a handful that survive, and they'll go up a lot more than they are now. And I'd be very careful about how you do it.
What about your long-term belief that kept you out of it, that the government will not allow it?
Well, I mean,
you change your mind?
I do, and you can see some of this now. Some credit card companies are saying you can't buy Bitcoin with it. Some banks are not allowing you to do it. So, you know, as it becomes more powerful, the government will react. And the interesting thing about it is they can make it illegal, but they can't really shut it down, right? Without shutting down the whole internet, they can't shut down the coins. But so, you know, if a government, you know, were to make it illegal, that doesn't mean you couldn't use it in Brazil or you couldn't use it in, you know, China, or I mean, and that government might attack it too, but on the black market, it could still be used. So I get, you know, I'm not telling you to go out.
What about eventually with the war on cash that a lot of governments, like, you know, India did, you know, called in notes that eventually that they let this experiment go on to get people familiar with it, because they would like to have a digital currency to eliminate the underground economy.
I think that's a very legitimate view. That I could very well see that happening. I think there will always be, you know, whether it's legal or illegal, I think there will always be a free market option against the government option. You know, and maybe that free market option has to operate in the black market or behind the scenes or however you do it.
The dark web.
The dark web.
Yeah, I don't.
You know, but so I think there will always
dark web is when, you know, I get a blue screen.
Yeah,
but,
exactly.
But you know, Brent, what a great interview, man. You know,
well,
really.
Yeah, I appreciate you having me on.
Yeah, I never know what to expect, you know, and it was really a great surprise to, you know, your depth of knowledge of the markets, and, you know, having a contrarian view that both the dollar and the gold can both be moving together for the same reason. And, you know, you're kind of a deflationary scenario is what you were describing. Like it or not, buddy, you're now my trading warrior brother.
Sounds good. Well, I appreciate you having me on.
Okay, Brent. So the best way for people to get a hold of you or follow you is at your Twitter handle at Santiago AU Fund, or you want to show do you have a website you'd like to show in the closing minute?
Let me just, you know, I due to legal reasons, I can't have a lot of information on my website, but if you just go to santiagocapital.com, you know, you've got there's my email, my phone number. Happy to talk to anybody or answer any questions or send any presentations that people are interested in.
See, the government saved you a lot of money. You didn't have to, you didn't have to put 50 grand into your website. So
exactly.
Again, thanks so much, Brent, and good hunting to you, and best of luck. And maybe we get together, you know, 3 months down the road and see how things are unfolding.
I'd love to do that.
Okay, Brent. Thanks you again for your edifying the faith community. Everyone, that's a wrap for us. Thank you, everyone at investing.com for joining us today, and we'll wrap it up with TGIF tomorrow. Remember, don't just count your pips, count your blessings, and we'll see everyone tomorrow. Enjoy the rest of your day. See you in the private chat room. Adios.